Well, let's stick with the earnings then, and lots of numbers have been flowing in. BEML is the next management on our radar. The numbers came in slightly higher than estimates for the fourth quarter, but the issue is on the order book growth and the revenue growth, because for the year as a whole, FY25, BEML has been slightly shy of its own sort of projections and earlier indicated estimates. We have Mr. Shantanu Roy, CMD at the company, joining in. Mr. Roy, thank you so much for being with us. Really appreciated. So I just want to highlight for viewers, the order book guidance that BEML gave out at the start of the year was about 18,000 crores. You've ended the year at 14,600 odd crores. And the revenue growth guidance you had given was 20-25%. But revenue growth is very flat. I think for the year you've not had growth at all. So can we talk about this first? What do you see? Maybe it was lumpiness of orders, had the orders spilled over into FY26. But let's start by talking about growth of the order book and what sort of revenue growth will you expect this year?
Thank you very much. So first of all, let me talk about the order book. Yes, we could not meet the guidance of 18,000 crores, but the silver lining is that the order book as on 31st March 2025 was around 28% more than what we opened the year 24-25 with. And the silver lining was that out of the total order inflow, the 67% contribution was by rail and metro, around 26% by mining. Defense was a dampener. Defense, we could do only around 9%. But if you look at the overall order book position of 14,610 crores against, again, the rail metro sector, it contributes around 63% to it, 24% from 28% from defense, and around 9% from mining construction. There were few headwinds. The orders, the contracts did not fructify in the last financial year, but we are expecting that in the first quarter, some of them would, and by the second quarter, it would to a great extent. As far as the top line is concerned, you see it was more or less flat, I agree, but at the same time, the silver lining is that the PBT and PAT is at an all-time high. So that's a silver lining.
Absolutely. No, sir. No taking away from that. The margin performance has been very good, and we'll come to that in just a bit.
Let us discuss the top line. The top line, basically, we have three business verticals. Last year, the contribution was 43% mining, 38% rail metro, and 19% defense. This year, mining has gone up to 54%. Defense has gone up to 27%. But rail is down by 50%, around 19%. So even though, rail did not perform, but still we managed to have the similar kind of top line. There were certain headwinds in rail, some of the order execution that we were planning, it could not happen because of the proto clearance and other stuff. And also, even though rail is having the highest order book, as I've always maintained in the past as well, there is a gestation period. The gestation period is generally 18 to 24 months before we come out with the first proto. So 25-26, the year when, projects like the Bangalore Metro, even the Vande Bharat, the balanced 9 trains, this will all reach its, Vande Bharat will complete the order. Bangalore Metro will start execution. We are supposed to do 20 trains this financial year. So whatever we could not do last year in rail and metro, it will be made up in the current financial year. And of course, defense, there has been a phenomenal growth. And this year also, we can expect a phenomenal growth in defense.
So, sir, can you just help us put that into some sort of a rough numerical range? Since obviously, these Vande Bharat orders, the metro orders are picking up, you're saying defense is picking up. So for this year, what is the kind of revenue growth we should work with, at least right now? What's the visibility? And what is the kind of order book growth, or maybe an order book number that you can share that you see ahead?
So first, let me talk about the revenue. This is just the beginning of the year. We are in the second month of the new financial year. And what we are looking for is around 20%, again, 20% growth in the revenue. What with the rail projects firing up this year, that should definitely become a possibility. If we talk about the spread or the contribution of different verticals, so in 25-26, we should be having something around 60% by rail and metro and defense and 40% by mining. Order book, as far as the current scenario, what it looks like with some spillover orders in the rail and metro. So the current order book of 14,600 crores as of 31st March, we should be hoping to double it in the current financial year. Again, it will be led by rail and metro. 60% contribution will come from the rail and metro. A lot of metro projects which we have already bid for, it will be decided in the current financial year. Some of the rail projects also, like the track machines and all, which we have already bid for, it will be decided in the current financial year. And 20% each from defense and from mining. That is what, it looks like currently.
And so total order book, we should expect, will swell to about 30,000 crores by the end of the current year, right?
I said doubling it. So doubling it should be around 28,000. And from 28,000, we'll be executing some as well. So we should end up the year at around 22,000.
Okay.
20,000. Got it. All right. Hi, Mr. Roy. Good morning. Good to see you, Ben. Let's talk about the silver lining first, as you were stressing on that. Margins have improved for the year, which is heartening. What is the margin target for this year? If you could give us a rough number. You've been talking about margin improvement, so I wanted to understand where do we end this year with, point number one. Point number two is exports as a percentage of the mix. With that 20% growth, how much will it contribute to your revenues?
So the margin, if you talk about the EBITDA, we have achieved a growth of around 12 basis points. And right now the EBITDA is around 13.2%. So we are looking at a EBITDA improvement of at least 15 basis points in 25-26. Exports contributed around 8% to the top line in 24-25. So we are looking at something around 10% on the exports for 25-26.
Okay, all right. So I just want to clear the point on margins from around 13%, 15 basis points or 150 basis points. Will it be closer to around 14.5%?
Yeah, it should be. It should be.
Around 14.5%. So around 150 basis points from around 13%, it improves to around 14.5%. Yeah. Got that out of the way. And just one quick question on the working capital days, that as well has got stretched a little bit. Yeah. Receivable days have moved up, inventory days as well have moved up. On a steady state basis, will this cool off?
It will. It will. That is one of our main focus areas. Our aim is to improve the return on capital employed and the return on equity as well. So the return on capital employed, for that, we need to bring down our inventory, and we also need to bring down the receivables. Unfortunately, the inventory, it was increased because we could not convert, for example, the Bangalore Metro and the Vande Bharat. We were having the inventory, but the sales will start from 25-26. So this year, 25-26, should see a drastic improvement in the inventory levels.
You want to give us the number, working capital days, sir, that it'll take care of the payables, receivables, inventory days. So, if you're talking about improvement, how many days? What does it come down to?
Well, it's very difficult for me to, tell you the guidance for the number of days. But what we are looking at is bringing down the working capital by at least 15% in 25-26.
Mr. Roy, hi, good morning. On defense, could you give us, that's been the topic of a fair bit of intense discussion, whether we're going to see a ramp up in defense business, added thrust on indigenization, and you're very much part of that plan. Could you give us a sense of how that is panning out? What have you seen, especially, what have you heard also from the government after Operation Sindoor?
You see, I mean, this current situation, it has been a revelation. India as a country, we as a country, have again proved our mettle. And as a defense PSU, we have been able to contribute in our own way. There is a lot of emergency procurements which will be supporting the government. And our forte is the land systems, the platforms, and we will be supporting the government by way of the platforms. We can expect more numbers of platforms to be manufactured. And that's the reason, we see at least 20%, more than 20% contribution of defense to the order book in 25-26. Apart from platforms, we are also working on, the combat engineering options like the mine plow, self-propelled mine barrier, and there are other mining mechanical minefield equipment, which we are currently doing. So these are all related to our core business in the land systems. And apart from that, we will also be looking at, diversification to the maritime naval. We are already working on some projects, as well as contribute to the aerospace sector. So it augurs well for the company. And as a defense PSU, we have ramped up our defense contribution to the top line to an all-time high of 27%. And I can see it growing to at least 30% in 25-26.
And margins here, sir, just 2 points actually. One is on aerospace, what exactly are you doing? Because largely it is land systems, as you said. And second, for this business, will margins continue? Where do they stand, and do you see a continued improvement on EBITDA margins?
Let me first talk about the margins. So margins, as I've already mentioned, definitely there will be improvement. This year, the margins have been driven by two things. One is we were able to reduce our material cost by 0.8%, and even a 1% reduction in material cost adds to the margin in a big way. Second is our sustenance. The sustenance contribution to the top line has been around 26%, and that has been a huge contributor to the margin. So as we grow our sustenance business, I expect the sustenance business to grow by at least 30% in 25-26. So we can expect even better margins. As far as aerospace is concerned, we are already working on several programs with the ISRO, as well as several programs with companies like HAL, and on development projects, mainly for the aerostructures, for the GHE, GACs. And we expect to ramp up the aerospace numbers in 25-26, especially the order book. First is having the order book, and then 26-27, the execution will really start for the aerospace.
So just for our understanding, ballpark, I mean, roughly speaking, are your defense business margins lower than metro and rail? I'm guessing metro and rail would fetch you the highest?
Again, that's a very difficult question. Metro is an intensely competitive market. Rail, I would say, commuter rail, the mainline rail, it has got better margins, but metro also, definitely we have the margins, but I would say it is in single digits. Defense, definitely, again, there is intense competition as well. In fact, more than 87% of our top line is from competitive business. So defense, along with high-end mining and the commuter rail plus the sustenance, it adds up to our margins. It helps us in improving the margins. So more we do of these things, better the margin.
The better the profile. Got it. So the commuter rail segment, high-end mining, and some specific defense and aerospace projects.
Specific defense, aerospace, and sustenance.
Got that, sir. Thank you very much. Great conversation, and we wish you good luck for the rest of FY26. Quick